Rapela.
Oh no, I had muted myself, sorry. So yeah, I think the guys are back right now and we can be able to kickstart the session. So yeah, so they are back then, not a problem, we can kickstart the session.
Can I start? Okay, cool. So yeah, earlier.
Yeah, you can just go ahead.
Okay. Just a quick recap. I touched on the conjugate principle, how the money flows to take advantage of natural person lower applicable tax rate and certain rebates that might be only applicable to a natural person. So if you've got any question, please raise your hands or send the question to Rapelang. Can be able to do that. And then the next principle is I just need. Unfortunately, it didn't keep my fancy drawings, and I'm so upset right now. So I needed. Okay, let me just touch on here. So remember, here was a family trust, and then okay, let me. Okay, and then that here is that what do you call will be having that company here. So we still have that company here, that sort of a trading company. So unfortunately, it didn't keep my my fancy drawings. So we still have those beneficiaries here that we take care of them. And then our money flow still goes here. And then the money still, what do you call, money still moves from company to the trading trust. This is our trading trust. So now the next principle that typically people do to sort of create and preserve wealth is to keep pumping money here at the family trust here. Now, one of the principles that we use in that are there from the tax point of view, it's 100,000 donation. And every natural person is entitled to 100,000 donation every year without being subjected to a donation tax, right? We all know donation tax. For every money beyond 100,000, you are subjected to 20%. So I always say donation tax is like a cousin of estate duty because the tax rates are similar. For up to 30 million, it's you're subjected to 20%, and then over 30 million, you're subjected to 25%. Thinking of donation, it would be very interesting to know how the Rupert and then Oppenheimers with their 1 billion donation, if they were exempted from paying donation tax. That would be very interesting to know how their transaction was structured. But every person or every taxpayer or every individual or any person for that matter, including companies and everything, anything that you're donating, it gets subjected to donation tax. So a natural person is allowed to donate 100,000 up to 100,000 without being subjected. So what we do now, bear in mind that as a small entrepreneur, as a small medium enterprise owner, you don't necessarily have to have that 100,000. The beneficiary doesn't really have to have that 100,000 actual. So it can be a bookkeeping scenario where you every year, if you've got this family trust, your accountant, what they need to do is create donation where you as a beneficiary end up owing this family trust that 100,000. So you don't necessarily to have it. If you've got it, good shot, but you don't necessarily. So what that helps you is that over the number of years, you're building up reserves here. Meaning that, let's say you've been putting in 100,000 for the next 5 years. It means you owe this family trust about 500,000. So meaning that if it happens that you've got assets in your name, you can effectively take those assets in exchange of what you're owing, and then meaning that you can actually write off that loan that you're owing the family trust, that 500,000, and then just send it over, that those assets that you own in your personal name. Then you'll not be subjected to donation tax, because you effectively taking basically writing off the loan that you're actually owing that family trust. So that's what most people actually create wealth in the family trust. We use that principle, we play around it. So what I've seen recently, some of our clients, what we do, we've got shelf trust. So shelf trust is more like a shelf company. So you find that this shelf trust it's old, it's like 10 years old. So when you buy that shelf trust, so what we do, so we go back and backdate. We go back and backdate the transactions, 100,000. So you and your husband, or you and your wife, for the last 10 years, we backdate those 100,000 donations. So meaning that over 10 years, you'll have roughly 2 million that you can donate. So you can effectively use that to transfer some of your shares, depends on how much your current shares worth. You can actually use that to transfer the shares actually into the family trust, or into this, for that matter, into this trading company, for that matter, depending on what type of assets you want to transfer. Because like we said, and like Bruno said earlier, family trust, we prefer that it's sort of a family wealth. I always say, how many of us actually were caught red-handed by this COVID thing, by this coronavirus? Because uh, reading from the social media, most of us, we don't have reserves. We don't have reserves to actually go through the lockdown. We don't even have reserves. If we are so scared, because if this thing runs on for the next 6 months, how many of us can actually stomach this? So this is where this family trust comes in, because it needs to, on a day-to-day basis, when you are creating wealth, it actually needs to be building that wealth. And one of the things that we're using is these 100,000 donations that we are keep putting in every year as we are building wealth within the trading trust and the various companies. But this is what you can use during the rainy days, like unknown occurrence of situation in the near future. So you can use it as a stimulus package, as a sort of a fund that can actually relieve pressure from during these problems. Let's say now you are about to lose key employees because of this coronavirus. If you have been building wealth, these 100,000s or other reserves that you have been building in the last 5 years in the family trust, you can effectively loan this money into this trading trust, and then the trading trust loan here. So now this brings me to a third principle of using loans to play around and creating wealth. So what do we do now with these current difficulties? If you have been building reserves, you can effectively say you need 500,000 that you for your companies to actually retain your key personnel, or to be able to stomach these unknowns. So you can effectively take money out of your family trust and loan a trading trust, then loans this holding company. So meaning that there's a loan, right? Now, this actually present a nice, interesting opportunity, because what happens is that when the economy restart now, and when we the whole lockdown thing sort of disappear. So now what are you going to do? These loans can start paying what you call interest income. Now we go back to a conjugate principle. So when this company now pays this interest income. So now in this one is interest income, and we remember we're still using that conjugate principle. Then we move in that conjugate, what do you call it, the interest income into the family trust. But because we don't want to be subjected to 45%, that if we keep this interest income in the family trust, it will be subjected to that 45%. So what we do then, we distribute that rental, that interest income of that loan to beneficiaries. So now the beneficiaries, say you've got 5 beneficiaries. We all know that natural person by tax law is allowed, I think right now, if they didn't change from the budget speech, it's about 23. Normally they adjust it every year. So last year was about 23,800 interest income exemption. So if, for instance, say you've got about 100,000 coming in here as a interest income, what do you call, as an interest income coming from this or as a result of that loan. So you can distribute that using the conjugate principle so that it gets taxed in the hands of the beneficiary. So because of that interest income exemptions that each natural person, by the virtue of them receiving interest income, they're entitled to take advantage of it. Then meaning that 23,000 each person is not going, meaning that effectively in that 100,000 we're not going to be taxed. Then what do? We use the principle number 2. Remember the principle number 2 of natural person being entitled to 100,000 donation every year. So these people can still take that 23,000 and take it back. Remember, we're creating wealth in the family trust. We're building up wealth. So they can take that under using the donation amount that they're entitled to, and then take it back into the family. Effectively, we sort of suck money out of the holding company back to family trust without being subjected to tax. Just playing with those 3 principles, and that's basically how we moving the money. So when we're all doing this, we're also taking advantage of what I have alluded earlier, avoiding to build up an higher estate duty. So as moving money back, we're covering the 4th principle of estate duty planning. So meaning that we're taking money away from the beneficiary, meaning that so that the beneficiaries don't even have money in their name as an individual, as a natural person. Because if they do that, they keep building up wealth under their name. They effectively building up estate duty, because eventually they'll be liable to estate duty on their death. We all, like Bruno said, we've got a lifespan as individuals. So now we need to avoid that by all means every year. Then we move this money back into the family trust. And then we all know the key principle of family trust is the rainy days. Rainy days is to take to take care of us. It might be taking care of your kids for school fees, might be buying hopefully those private jets in future. So that's where everything is going to play, so that the wealth is still protected, that take advantage of the asset protection that the trust actually present you with effective, but then also avoiding paying 45% using all those principles. Now, one may ask a question, say, but then hang on, what happens if these beneficiaries, because remember this beneficiary over a number of years, say 18 years, say your kids now are like 5-year-old, 6-year-old. These kids eventually, say you've got 4 kids here. These kids eventually will want to be on their own. They're going to be young adults, they're going to start families. How do we then move this money here in this family trust without being subjected to funny taxes and be able to set up these kids? So what I've seen, there was an Abraham case where I've seen what they did, because, I mean, people are different. You may find that people don't want to be sharing these. We've got various family dynamics. So you don't may find that, okay, you just want these people to go and create their own lifestyles. Maybe this kid here, this beneficiary number 1, is interested in the music industry. Maybe this one mining, maybe this one property industry, maybe this one you just want to be a nerd. So now, but you still want them to have a secure future. You want to transfer money away to them, but without them actually also being reckless with money, still being under the guardianship that get preceded by the trust and the independent trustees. So what that does, it gets me to principle number 5, where by the current legislation, by Income Tax Act, it present a certain exemptions. So one of the exemptions that we found in section 56 is around the donation that get made by the trust in pursuing the beneficiary interest. That's a very interesting thing, because in one of the cases, Abraham cases, what happened is that, so these beneficiaries were about 6 of them, if I recall. So in this case, in our example, say we've got Shili Boy family here, then we've got about 4 kids here, and then I want to set them up. So now what they do, you set up another, let me draw fancy, smaller Shili Boy juniors. So now what you do then, so now the fancy thing here now, what you do, you take advantage of section 56, you're transferring wealth here. Sorry guys. I just want to remove this man here. I'm not sure why is he so jealous. He wants attention. So now what you do, you transfer this money here using section 56, donation exemptions under donation tax. So now it allows you to move money here. If say you want to set up these kids, you can set them up and give them 10 million each in the future. Remember, we've got wealth. It goes back to that principle of transferring of wealth, right? So now, what trust actually gives you that opportunity. So now you transfer this money from the family trust. You're setting up Shili Boy Junior 1, then you give him 10 million. By using the donation, no tax whatsoever. Because Shili Boy Junior 1 was the beneficiary of this. So now you're setting up. Junior 2, you're setting 2. Junior, you all set them up, and then effectively you might, if you wish, dissolve this. It's no longer necessary, because what you're doing, you sort of set them up without any sort of what do you call, any sort of tax implication, because the current legislation allows you to. Most of people are not aware of these wealth transfer principles, that you can actually take advantage of that. So that is very, very important, because that's how you transfer wealth. That's one of the easiest actually privileges room to actually transfer wealth from one generation to. Because one of the things on a day-to-day basis when we are trying to create wealth is particularly to be able to take care of the generations to come. We always say we're pursuing intergenerational wealth, but the question is, how are you going to transfer this wealth that you're working so hard to be?
Hello, Shili Boy.
That we also, as Intergen, we are able to create, and then it able to guide these junior beneficiaries.
Hello, Shili Boy. Shili Boy. Hello, Shili Boy. Hello, can you hear me? I don't know if
I think something might have, obviously gone wrong with his connection. He's been struggling with it. Maybe just allow me an opportunity. I'll just let him know he's off, just to give him one more chance. And if it doesn't work, we can take it from there.
Oh, okay.
So Bruno, can I suggest that you take over the session until we get Shili Boy on the line? Rapalang, you can call him on his cell and let him know Bruno will continue until he has a better connection.
Shili Boy is back. I'm not sure if he can hear us, but maybe. Hello, Shili Boy. Are you able to hear us?
Yeah, I can hear you.
Yeah, we just keep losing you a little bit. I think your connectivity is not that strong. So maybe while you are using the board, just try to mute your video so that the bandwidth at least can be shared.
Okay.
It cannot be pressurized from that side. Yeah.
I
So
see.
just mute your video when you are using the board,
Ah,
just so that we are able to not lose you.
I see what you mean. Okay. Let me do that. Okay. Okay. So I'm just gonna quickly go back to quick one, and I think so far we are familiar with my roundables, and then these are those juniors that I was creating. Quick one. We remember the principle that we did was to move the wealth quickly using the section 56 that allows us to move the what do you call to move the family wealth, but to the beneficiary. But then a question can be asked to say, but Shile boy, how do we then increase wealth, create wealth within this family trust? It can't just wait for this company here and then the property trust here. Just quick reminder that here is that property not property trust, but rather I'm used to property industry. This is business trust quickly, and then here is that family trust that we are creating. So what I've seen, what we've sort of created because of the benefits that are out there, tax benefits that are out there. What I've seen, some of my clients that we take advantage of is what we call endowments. So endowments, it's what you call after tax investment vehicle that are just literally beneficial. So endowment investments I get taxed at 30% flat rate, meaning that for anyone who's already sitting at above 30% tax rate can actually benefit a lot using endowments, because say for instance we've got wealth here and we're getting, say, um, we already pumped it in using those principles that we explained earlier on about those 100,000 principles and the conjure principle. So meaning we can take this money actually and invest it into endowment and get taxed at the any income, sort of interest income, depends on what we're investing. Some of the endowment can actually invest in properties. So meaning that all those monies that we are getting will be taxed at 30% as compared to 45%. So meaning that we're saving at about 15% of typically what we would have saved in a normal scenario. So those are some of the things that principle that we can use actually here for the tax principle that we can use actually to create a lot of wealth within the family thing, and we build up wealth. And endowments are just easy to cash in because within in a space you are okay. One of the key things that we need to be aware of is that you need to lock it for 5 years. So you lock that 500,000 for 5 years. You're allowed to withdraw it twice. You can take a loan or you can cash it without incurring any penalties whatsoever. So now it presents also a nice thing because it presents a growth potential. Say for instance, for that 5 years, you locked yourself in high growth investments, say properties, equities, and offshore investment, hard currency investments. It allows you now to build up a high growth within the trust that will be subjected to tax at 30% as compared to 45%. So that's typically how you're going to create wealth. So it presents you with that growth. So now the question one can say, but what happens when we cash in and then will be subjected to that 80%? Remember, trusts are taxed at 80% capital gain inclusion. So now forget, well then instead of that being taxed at 80%, our capital gain from cashing in our endowment, we go back to principle number one, conjure principle. We take those what do you call the capital gain, we distribute back to the beneficiaries that might be at the lower tax rate at that particular point. Remember, now we might be sitting with grandkids who are now in schools, depends on who our beneficiaries are. then we can take advantage of that and then distribute those capital in gain and then include them at 40% as compared to 80% that the trust will be subjected to. Then there will be tax at the lower tax rate here also. Then we bring it back using those principle again of those 100,000 and then the loans and the donation. So that's how you can move. So the endowment is one of the things that you guys and they're easy. They're all over. I mean, a lot of companies are actually presenting those type of after tax investment, but you can actually take advantage of them to create wealth that will be able to sustain you during the rainy days, during the uncertainty times like what we're experiencing currently. Those people that have been doing this thing in the last 3 years are rest assured because their companies can easily now go back and actually do what I was saying earlier on, that they will be able to cash in from the family trust and then be able to loan their business trust, and their business trust will be able to inject money into their companies, respective companies, because over the last 3 years or 5 years or even 50 years, some people actually build up this family trust here. So now, when I'm talking of those endowments, it actually brings me back to what you call Section 12J. I'm not sure how many of you guys are actually aware of Section 12J. So in a nutshell, Section 12J actually, it's sort of a tax legislation provision or section, rather income tax section, that the government has sort of introduced to be able to stimulate economy. It was actually copied from UK. This principle was actually copied from UK. I mean, the guys like Westbrook is one of the 12 biggest 12J companies in the country because it's actually originally from London. So what Section 12J, one of the key benefits of Section 12J, I always say, is the time value of money. So what it does, it says to you, if you've got say $1 million right now, right, and you invest this million right now in a 12J, VCC, which is venture capital companies, you will effectively be allowed to deduct this 1 million right now, meaning that you will effectively get a return of about 45% if you are a taxpayer at 45%. So imagine if this trust here, it was to charge management fee, because that's another way of getting money. And that's a question that one can answer, Shilpe, but then how do we move money from this holding company into here? One of the principles that I can touch on it, that work hand in hand with 12J, it's management fees. Because what management fee can actually work is okay, I just want to create another error. So this company, the business trust can actually charge the holding company a management fee depending on the arrangement, because remember here you might actually make it the trading account company, and in such a way that there are maybe 1 or 2 employees within this business trust, and then you are able to charge management fee. There might be various things. It might be you are raising money, the trustees are charging this company because they raise money on behalf of this trading company, so then you are justified to charge them raising fee. So there are many ways you can actually move money here without being subjected to tax. Then you move that money here, right? That management fee, you move it back to family trust, right? But remember, if let's say you are moving 10 million, so now meaning that we can no longer now move this money to the beneficiaries. So what we'll then typically do, then we say, okay, we'll park it here. But if we park it here, we'll be subjected to 45% tax rate. And that's a lot of money, of 10 million. So now what we'll do is say, okay, why don't you then invest in Section 12J? Because what then Section 12J allows us is that the 45, that 10 million that will typically have been subjected to 45%, or that 1 million. Let's go back to my example of 1 million. Say it's a 1 million. Say, okay, instead of just packing this 1 million here and be subjected to 45%, why don't we just take this 1 million and put it in a section 12J VVCC? And then from there, what you do in that financial year of investing in section 12J, the trust will be subjected to a reduction, will be allowed section 12J deductions of 45%. So meaning that the trust at the end of February, being a financial year end of typical of trust, then will be allowed a deduction of that 1 million, and then trust will be returned will have a return of 450,000, meaning that instead of paying SARS 450,000, actually SARS gives you 450,000. That's the beauty about this. So what most people do then, they take that 450,000 and then actually buy after tax investment. So meaning that you can actually even take that 450,000 and go and buy endowment, you can go and buy preference shares, you can buy equities, you can buy concurrents, you can buy other things, and you are building wealth again. So basically, SARS has subsidized you to do that. So now, where's the catch? The catch with this 45 section 12J is that you need to lock this for the next 5 years. So what happens in year 5 after year 5? The investment will be considered to have what you call base cost 0, meaning that it forgo this 1 million. So you'll be seen as if you did not pay anything whatsoever for that investment. So now it means if the investment is worth 2 million at that year 6, so you'll be subjected to capital gain tax on the whole 2 million. 80% then effectively. But then if you do the numbers nicely, you will see that you have huge benefits, because but then on top of that, you've got time value of money over 5 years that you're actually benefiting. So one of the things then, if by then you don't want to be taxed in the family trust, when you cash in section 12J, you can effectively do conjugate principle and then transfer those capital gain back to beneficiaries, depending on who are those beneficiaries at that particular point in time are. But if they are already high net worth individuals, you might as well just keep it here, because you may find that it's actually not beneficial to actually distribute that. So these are a section that I felt that you guys can actually leverage, because section 12J, I know that through some of our contacts, is that there are a lot of various vehicles currently being developed. There's a one that is actually can be applicable to people that are fairly not, yeah. So which is considered what we call section 12J silos. Section 12J silos allows individual to actually, it's more like a stokvel. I always say it's a high class stokvel, because what it does, it allows an individuals to come together in a form of partnership and then all contribute together and be able to invest in section 12J, because one of the requirements that the minimum investment that you need to put in is about $1 million. So in that partnership, you can actually come together, even if it's about, say, 10 people, each contribute 100,000, and then you are able to go invest in section 12J silos, and then you can actually take that money still and invest in your in another, it might be property or a junior mining, because there are certain areas that there's a limitation, certain sectors that section 12J's VCC can actually invest in. So those who are in actually property in still gets in is one of the things we then we created section 12J silo. And then that allowed us actually to contribute even less money as compared to if we were to do a completely 12J VCC, which can be very expensive to actually establish. So these are some of the things that a family trust can actually take advantage of and still enjoy the tax benefit of that. So that also having moved money here using management fee, which is the eighth principle that I needed to cover. But then the question is, how do we avoid paying high tax on that management fee? Is using things like Section 12J, endowment, and then moving money like that. So one of the thing also that the common one is that dividend income. We all know, I think I've touched it already on it. So you can just move money just by declaring dividends and pack it there, and then you can just build up reserves there. Because I always encourage people to actually always try to reduce a lot of reserves in a company, mainly because trust and a company is more easily being sued. You can be having employees who are disgruntled, and there's always things. So I always try to move money away from the company to make it less attractive. One of the classic story was when PSG was under hostile takeover. It happens a lot. So when you build a company that it becomes so much attractive with reserves and cash reserves and attractive balance sheet, it might be subjected to funny takeovers and competitors trying to take over those attractive reserves. So I always try to move money into the business trust, or if I can, and then move it to family trust. So those are some of the things that one needs to think of, and taking advantage of the tax principles that are there, like dividend income. You can easily move this money easily here, because remember, a company doesn't have to declare dividends just because it made profit. And that's why I always argue, people say, but then if you are declaring dividends, you'll be subjected to 28% and a 20% withholding tax. I'm like, but doesn't mean the company has to be in a profit-making level for it to declare dividends. You can still be in a loss-making, but then still declaring dividends. Why not? You can actually refinance some of the property. Let's say you've got a couple of properties here. You can refinance them and take this money out in a form of dividends, and you're paying 20% tax, even though this thing is making loss. As long as your Companies Act provides that you should not declare dividends if the company is not it's not meeting those requirements, like assets over liabilities, all those things. So you just need to make sure that the Companies Act is followed correctly, and then you can actually move money using the dividend principle out of here and actually back here, just by refinancing some of the assets that you have there, cash in, and move the money here. So that's one of the way of actually building up reserves using on the individuals. So it just got me thinking also, even though it's not really related to most of entrepreneurs, it's around retirement annuity fund. It's just a beauty about it, because there's so much that people are actually not taking advantage of retirement annuity fund, mainly because people are being seen as a soft investments. But then the thing is, there's a lot of savings that you can actually, especially if you are high income earner. So you can actually take advantage of those things and benefiting from those exclusions. I mean, we're sitting at about 300,000 limit that you can actually take advantage of on an annual basis for the. So those are some of the things that you guys can actually take advantage. So just to recap in closing, before I hand it over to Bruno to take us through the asset protections and touch on some of the COVID-19 issues that might be happening, that might be applicable from legal point of view. I just want to recap some of the principles that that I covered. I covered the conduit principle. I covered the 100,000 donation. We spoke about that each natural person is entitled to 100,000 donation per year without being subjected to donation tax, which also a company can actually donate money here, but then the disadvantage is that companies can only donate about 10,000. So it's not really a lot of money, but you can also move the money to a business trust by just donating 10,000 every year as a company. I mean, yeah, as much. It's not a lot, but yeah, it's something that you can actually exercise. You've got the right to do that as a company. You can donate 10,000 there. So that's my second principle. And then the estate planning is that never have a lot of assets in your personal names. Never. because you are building up estate duty tax. That's about that 20% that I explained, that for the property values, or remember, property by definition of estate duty is not a typical property as we commonly used for meaning that isn't like physical property. It might be crewcarens, it might be any other form of properties that you own, it might be cars and all those things. So they will be subjected to 20% if they're below 30 million. So from estate duty planning point of view, I wouldn't advise people to be building up wealth in their name, because you'll also be subjected to capital gain tax on the date of death. So, and then effectively meaning that if you are building wealth in your personal name, you are effectively donating money, because close to about 50% of what you're building in your personal name will effectively be going to SARS. Just on touch on that, for instance, if you say, and I mean, that happens a lot with most of us as entrepreneurs, especially that we love ownership. So you'll build a company, it's a new company, you go to CIPC, you subscribe for it, you register it, you own shares in your personal name, and then you fortunately build that company to worth about 50 million. That means your shares actually, because when you subscribe for that company, you probably even paid like R1 to just kickstart that company. Share subscription was about R1. So it means by then, when you build that company to say 50 million, the net asset value, which is going to be what SARS will say is the worth of your shares, it might be sitting at about 50 million, or say, for argument's sake, let's say, for argument's sake, say 10 million. So meaning that you'll be subjected to capital gain tax on that 10 million. That's a lot of money. So it really doesn't make sense as compared to if you had actually built up a wealth, those shares, and actually transfer them in a trust, so that even if you die, you are not going to be subjected to that estate duty planning. So we spoke of loans, on how we can actually move money around and then take advantage of interest income. And then also that allows us to actually loan interest-free loans within the basically within intercompany loans. So we can take advantage of that. And we spoke about the transferring of wealth from one generation to the next using that Section 56 principle, where we can just move money from the family trust and then to these Shiliboy Juniors 1, 2, 3, 4. So you can actually move money and set up your kids without being subjected to actually donation tax, and then you can do that. So, and then we spoke of endowments that can be used to actually build family wealth that are being taxed at the very flat rate of 30%. We can take advantage of that. We spoke of Section 12J, which I'm very, very passionate about, and I think is coming to an end in 2021, with the hope that especially with the current economy that we're in, recessions and things are just hectic. I don't see National Treasury actually canceling Section 12J. I see it being extended with another 8 years. So meaning that we've got an opportunity to actually take advantage of these in the next 10 years to build up family wealth using Section 12J. So now, and then we spoke about management fee, how we can take money out of the holding companies and then moving the money into the family trust, taking advantage of endowment and Section 12J. So we spoke also of dividend income, and then I also touched on employment tax incentives that we can take advantage of it at the holding company. So those are some of the plans, and then also how do we motivate these employees, and the beauty is that then you can start taking advantage of things like employee share trust to motivate and also to increase the BEE level, because as much as some of you guys might be Black-owned companies right now with a great BE level, as the company grows, really, it doesn't really matter even if the ownership is like Black. So you need to start putting in certain BE measures that will contribute to the growth of your level, BE level. So employee share trust actually works wonders because it motivates employees because they feel like they're owning these companies. On top of that, it actually gives you a nice BE level. But then the beauty is that when the employee leaves your work, they actually forego being beneficial of those employee share. And then you can even set them up for like 10 years, because I know as entrepreneurs, we always want ownership. You know, we love this ownership about our companies. We love them so much. So, but then, yeah, effectively, you can just structure this employee share trust for 15 years to 20 years. You don't have to make it indefinite. So those are some of the things that I think from the tax point of view, you guys can take advantage of that. So I'll be more than happy to actually take questions around these sort of about 12 principles that I sort of designed that I think can actually help us to create wealth. And the beauty is that you don't have to wait when you're a multi-millionaire to set up these things. Like we see with that 100,000 donation, you don't even have to have 100,000 donation every year for you to take advantage of it. The fact that you've got the trust can actually start raising those 100,000 donation every year, meaning that you owe effectively owe your trust. So as soon as you make money, you repay that loan by just transferring those money back into those family trusts without even being subjected to tax. So these are some of the principles that I'll be more than happy to take questions. And I think I'm gonna hand it over to my colleague Bruno to take us further on asset protection. Thank you, guys. Raphael?
Hi, everyone. Sorry.
No, go ahead, Bruno. Go ahead. Okay.
Yeah, no, Bruno is back, so he can carry on.
Sorry, give me one moment. I just want to get the slides up and running. There we go. Great. Cool. Excellent. We've got about half an hour left, so let's jump straight into asset protection and the legal implications. But let's just take it one step back. So we had the three structures that we were dealing with, and I'd explained to you the pros and cons as we went along, which ones carry personal liability, which ones didn't, and how the different levels of asset protection one would anticipate experiencing as working through these three different vehicles. So I touched on many of the things, and I did explain the bottom line is that as an individual, you do carry personal liability. So let's look at quick examples. So let's say that you're running a business and you're running it as a sole proprietor. So you're the individual that goes out, does the jobs, gets paid for the jobs that you do. The problem that you sit in situations like that is any assets that you then buy in order to do this job. So let's say you're a tradesperson, you have certain machinery or equipment that you use in doing the jobs. Now this equipment is in your personal name. Your business is in your personal name. So if anything happens in your personal life, so let's say, for example, there's a divorce that ensues. There's, for instance, okay, it's happened plenty of times. There's a car accident and you're not insured for, your vehicle's not insured, resulting in the person that you possibly bumped into wanting to claim the damages from you. And since you're not insured, you'd need to carry those damages. Or what I've even found, especially in South Africa, it happens quite often, insurance companies repudiate claims if, for example, you'd been drinking. Even if it's not necessarily your fault, the fact that you had alcohol in your system could cause an insurance company to repudiate the claim. Things like that happen all the time. Personal liability, for example, when it comes to somebody coming to your office and tripping and breaking a leg because the floor was wet and you having to cover the medical expenses. There's a whole range of different ways that liability can arise in your personal name. Stupid examples, but it happens in day-to-day life, are things like common assault, people getting into fights. People getting into fights, maybe assaulting somebody else, and there being a claim because of that assault or some sort of insult. If you verbally insult someone or say something derogatory, they can sue you for things like defamation. So those are just small little examples of things that happen in your personal name. Now, as soon as things like this happen, or you're running two businesses in your personal name, you're exposing the other business to this. So that's the type of asset protection that we're speaking about over here. You want to avoid things like that from happening. You want to avoid exposing your shares. You want to avoid exposing IP. You want to avoid exposing, whatever, those gold coins that you have, or those expensive paintings, or whatever the case is, those reserves that Shirley Boy is speaking about, you don't want to carry them in your personal name. You want to build those reserves somewhere where you can utilize them without anyone ever having to, or without you fearing that anyone's ever going to get their hands on it. So that's what we're referring to from asset protection. Now, as a company, for example, a company in itself doesn't necessarily give you a great amount of asset protection, because as I mentioned before, the fact that the shareholding of the company is held in your personal name basically means that those shares are exposed. So even though the company runs the business separately, which is good, because like this, if the company gets into trouble, they can't necessarily come after you personally. So that protects your estate. But the problem is that the company isn't protected from you doing something wrong, because those shares, which are in your personal name, will be exposed if you do anything wrong. So that is one of the primary reasons why we suggest that structuring that we had mentioned earlier, where a trust holds those shares. Because by a trust holding those shares cannot be executed upon, and that's what you're trying to achieve. That's just an example of a situation, or of a situation where we get the best asset protection. And why is this important? Well, the honest truth is that the trust in South Africa is really the only asset that we have that offers that level of protection. Because like I explained, the shareholding in the company is attachable, but your benefits in a trust cannot be attached by creditors, because they don't technically vest in you. They vest in the trust. They vest in those trustees. And those trustees it's not part of their personal estate, so they can't be attached if they do something wrong. It's simply just vests in the care of the trustees, who can, in their discretion, hand them out or utilize them for the benefit of the beneficiaries. And none of the beneficiaries' creditors are entitled to force that to happen, meaning that those assets can pretty much be hidden, for lack of better words, from the world at large. So that is technically the perfect asset protection structure. One does obviously need to weigh it up with whether there's actual value, in the sense that if you don't feel that in your personal name you carry all that much risk, and you've got certain things under control, and you feel that you've got a steady job and you're not worried about certain things, sure, we can have we'd suggest looking into it and figuring out whether the costs outweigh the benefit. But as an entrepreneur, I'm almost 80% of the time sure that if you're wanting to build a business, you're wanting to build an asset of value, you're wanting to take certain risks, that in order to do so, you want to have the asset protection backing to allow you to trade as freely as possible. So on that note, exactly what I had mentioned. So claims that arise from an individual's commercial or personal life exposes the other life to unrelated risk. And these are your two lives. It's your business and your personal life, and you want to keep them separate. And you do this by using these structures. Another thing to mention, and this is obviously now, it depends on how you guys want to hedge this risk. But what I often tell people is that, again, it comes down to efficiency, costs, asset protection. So for example, if you have one company for everything that you do, you've got the best protection, because none of these companies are interlinked, meaning that one company does something wrong, the other companies are completely safe. But sometimes the downside to this comes in the form of financing, where it starts becoming difficult now to link the companies close enough and have all their balance sheets in order to get financing from third parties, because now they see a million different individual companies. And this also has implications when it comes to tax, where it's not always ideal to have too many companies doing too many things. But obviously the reason why people wouldn't do it is the cost. Because remember, each company that you have needs to keep records, needs to keep finances. So you'd have to pay an accountant on each company. You'd have to file annual returns, and things like that come at a cost. So this is why we keep saying that we balance things out. If it calls for different companies for everything, we do it. Sometimes we see that there's a level of continuity in having two things in one company, because they're related. So in one company, because you feel, you know what, it might be the most prudent thing to do. And like this, at least that company starts creating a balance sheet, starts showing income. So it's to your benefit. So things like that are worth considering. But the ultimate principle for asset protection is don't put all your eggs in one basket, because you don't want to expose different assets or different benefits because something went wrong. So so we've got about 20 minutes left. So I've dedicated that time to speak about COVID-19. So the most pressing question, and it's quite a pity that Mukhadi is not on the line anymore, but I am hoping that you know, he does see this. He does see this a little bit later. And obviously, you're welcome to post your questions. I do have the chat box live open here in front of me, so I'll be able to answer them. A little bit of a Q&A. So the reason for approaching it in a Q&A perspective is the COVID-19 outbreak and the lockdown are still very novel. So very few anyone, I mean, in any sector, has all the answers. Even government is struggling to properly regulate how certain industries are going to be working. I mean, I spent most of the evening chatting to my colleagues, different attorneys, about how the permits should look like, what they should say, whether a person is allowed to do certain things, because it almost touches on essential services. Maybe, maybe not. We're not 100% sure. We've had plenty of labor queries on whether people should be paid, whether people should be forced to attend, even though they are part of the essential service. What they're actually doing at the essential service isn't in itself essential. So should they really be going there and being forced to go there and exposing themselves to risk? So there's a lot of things in this current environment that I'm not going to lie to you, that I don't have necessarily the answer for. But we are communicating very closely with other attorneys and accountants, and we are trying to get to the bottom of everything as much as possible. Similarly, with Shilly Boy addressing some of the tax relief, financial relief that's being offered at the moment. Even with that, there's certain things that people simply don't understand. They don't understand how logistically we're going to go about doing some of these things. But in due course, it will unravel. I think, or not unravel, it will unfold or you know, come to fruition. I think for now, the most important thing is for us to be aware of it and be able to red flag certain points in contention and stay up to date on them, so that you know you get the answer eventually. So with the COVID-19, the first thing I would say is know your enemy, and what I mean by this is identify the downside, identify the risks, identify the issues. So, for example, knowing your enemy. I'm speaking to a lot of people who are showing more frustration at the government, for example. They're showing frustration at some of the handling of the situation. I personally think that our president dealt with it very, very well. Yes, some of the subsequent directives, especially by the Justice Department, I felt were a bit vague, but I felt that the general approach by the president was done quite well. So understand that it's not government that's your enemy at the moment. Now, we're actually trying to say, well, it's the virus. We need to deal with the virus. We need to deal with what the virus does. And the one enemy that I see popping out consistently is fake news. The fake news is causing a world of issues that are causing practitioners like myself to have to continuously address for no reason at all. So say, for example, there was a circular that went out a few days ago saying that people nowadays for residential properties need not pay rent. The COVID virus effectively puts an automatic payment holiday on the payment of rentals. Now, landlords naturally just started panicking, because remember, landlords aren't, well, you know, the picture of landlords, and I mean, I'm sure many of you own your own properties. The picture of landlords isn't, you know, guys swimming in money. In fact, some of the guys managed to put enough money together to buy a property in order to create wealth at some form of passive income. Now to be told all of a sudden that they have, you know, they're not going to be receiving any rentals at all, it's a shock to the system. And this kind of then brings me or leads me towards the next topic, which is how do we deal with COVID-19 moving forward? What do we need to do together in a group so that, you know, we can actually kind of endure it from a legal perspective, and endure it from a commercial perspective. And so the first thing, for example, is payment holidays. Now, a lot of people are jumping to certain assumptions because they see the big guys doing it. So some of the banks have said that they're willing to afford payment holidays to financially distressed individuals or small businesses. So, they're going to either defer the payment of certain loans for a period of time, or they're going to either defer or reduce, extend loan periods, or allow a holiday and everything will be paid off later in a payment arrangement, whatever the case might be. The problem that we're sitting with is we're not all in the same situation. So we cannot assume that simply because the larger banks can afford to do it and are actually being incentivized by the Reserve Bank to do it. Because even the Reserve Bank is making funds available in order to keep money flowing through our system. Take individual landlords, for example, business owners. We cannot afford to do this. So from a payment holiday perspective, a lot of people ask me, if I'm getting these holidays from some of the bigger players in the industry, does that mean I'm forced to pass on these holidays to the, to my guys? So for example, if you're a landlord that owns a property and somebody's renting from you, and you're getting a payment holiday, are you obliged to pass that payment holiday on to your tenant? The answer to that is no, you're not. Legally speaking, you don't have to do that. But again, this comes down to living in unity or standing together. If you are getting a payment holiday that you wouldn't have expected in any event, it is worth considering at least affording some sort of leeway or indulgence if you're getting it. But if you're not, and if you generally cannot afford to persist or continue, because you're not getting any financial relief or you're not getting any immediate financial relief, the bottom line is you don't have to provide that sort of relief on to the people that you're contracting with. And that kind of now starts touching on like rights versus obligations. So in this moment, we ask ourselves, well, we've got contracts. And it's two different types of contracts. So we've got certain rights. So in certain contracts, we've contracted to receive something. And now we're not receiving it. But in other contracts, we've contracted to do something. And now we're not able to do that either. How do we go about this? Like, what is the balancing act here? And the one legal principle that merits discussion is what we call force majeure. Now, all force majeure means is it's an impact on a contract following an event that's beyond somebody's control, and that applies generally across the board to absolutely everyone, and that it makes the performance of certain obligations completely impossible. And what force majeure allows certain contracting parties to do is to cancel and terminate the contracts, and to basically say that since they cannot perform, they need to retract from the agreement. Now, this obviously comes with implications. The first one logically being, if somebody's performed, they've given you something and you need to give something back, but now all of a sudden you're not able to. Bear in mind that you cannot simply terminate and say, well, I can't, so too bad, I'm walking away from this. The fact that you received consideration for that means that that consideration would have to be returned because it's unjust for you to retain it. So if there is going to be a termination of the contract, there will have to be some form of restitution, which is basically the return of whatever performance that you've given under that contract. So that's the first principle that one needs to bear in mind. It's not always as simple as getting out of the contract. But in a situation, for instance, where you've been in the construction industry, if you've been hired to do certain building works, and now obviously you're in a situation where it's not essential services. There are certain building works that may proceed as essential services, but very few, because you'd have to have an essential function or a means to an end, and that end would have to be essential. So most building works would have to be stayed at the moment. So what do you do regarding like penalties? So if you're a builder and now you're not meeting deadlines, what's going to happen? So questions like that arise with this. And like I said, it is still a learning curve because a lot of people are not considering how to address it. And just to give you an example, and I know this is sometimes very difficult to fathom or grasp, but I use two examples for this. So you have a tenant staying in a residential property that owes rent to the landlord. You have a builder that's being instructed to build something by a certain date. Now, in both these situations, you've got obligations. Now, because of COVID-19, in both these situations, performing is particularly difficult. But from a legal perspective, these are two very, very different situations. You see, when it comes to the builder, The builder cannot. It is impossible. The builder can't leave his house to build. He can still be expected to do everything else up to building. So for example, if the builder were to assist with the drawing up of plans with an architect, that there would be some expectation that the builder would be able to perform, but the actual building itself is not permissible under the lockdown regulations. Whereas the payment of rent, the residential rent by a tenant, is. Yes, the tenant might not have work. Maybe the tenant's suffering financially. Maybe he's on unpaid leave. But COVID-19 doesn't physically make the payment of rent impossible. And in fact, the tenant is enjoying occupation. So it allows occupation to persist and requires the payment of rent. It doesn't, a force majeure here wouldn't apply across the board, because arguably some people save up money and would be able to pay rent. Some people are receiving salaries. So over here, we're looking at one certain individual's incapability of, or inability rather, to pay rent. And under law and under force majeure, that is not a ground to terminate the contract. Yes, I'm not saying we shouldn't have sympathy on people that are struggling with this, sure. But what I'm trying to explain from a legal perspective, this contractor who cannot perform can go to the table and say, well, I need to terminate the contract because I cannot perform, and you're not allowed to sue me for damages or charge me anything because it's a valid impossibility that allows cancellation. Whereas with the tenant, the best case scenario is that the tenant pleads for indulgences so that a plan can be made between the tenant and the landlord. If I draw those analogies or examples, if anyone wants a bit more clarity, maybe just send through something in the chat. But that's basically the application of force majeure and your entitlement to actually cancel contracts in a situation like this. So moving forward, we're looking now at things like termination of contract and allocation of risk. So you're instructed to do a building or to build something, but now you cannot perform. Is the solution to terminate the contract? Maybe that's not a good idea. Maybe you went through a lot of effort in order to get the contract. You don't just want to send a letter saying, well, I terminate. So how are we going to deal with this moving forward? How are we going to deal with existing contracts that have now been stayed because of the crisis? And how are we going to deal with contracts moving forward? Because again, we shouldn't stop, and the president's made it very clear. We should not be stopping our commercial activity, because if we do, the country's going to be in a worse off state when we're out of this. I mean, the country's already going to be in a worse off state, but imagine the state if all economic activity comes to a halt. So what we want to try and achieve now is continue with commercial transactions. So existing contracts, we don't necessarily want to cancel, but we want to try now cater for what happens after this crisis is over. And this is where we start looking at allocation of risk. We start looking at these contracts and coming to the true realization that we don't know when the lockdown is going to end. We don't know how long this is going to go for. We don't know how much money or cash flow we're going to have in the process and how much work we can do in the meantime. But what we can do is we can try contract for as much as we can in the foreseeable future. So to give you an example, there's something that's called suspensive conditions in contracts. If you're doing a building, for instance, and you don't want to terminate the contract, but you want to try, keep it secured, but you also want a way out of it because you don't want the risk to be allocated to yourself. We use things like suspensive conditions to say the contract will be postponed subject to the 21-day lapse. And upon the 21-day lapse, everything continuing. If there's a second 21 days, then the contract will lapse. So we start using nice creative contractual wording to try and cater for what will happen in 21 days or 42 days. So you can do contracts saying, well, we'll enter into the contract right now, but naturally we can't do work. So we'll prepare A, B, and C. A, B, and C is normally part of the contract cost, right? So we prepare it knowing that we're going to execute and we're going to complete the building, for example. So we undertake the initial groundwork of doing, helping with building plans or whatever the case is. You can draft the contract even in a way where you undertake the work, you agree not to charge for it. But if the lockdown persists, let's say for 3 times, or persists for a period longer than X amount of days, that you'll be entitled to, that the contract will lapse, but you'll be entitled to claim the fees or expenses undertaken in the preparation of the material you've already prepared. So you can put value to it. So there's a lot that you can still do right now to try to secure these contracts and make sure that you don't lose them. And when we all get out of this, all of a sudden, people decide they don't want to proceed anymore, or people have found somebody else. So these are ways that you're going to be using to secure the contracts just by buying yourself enough time without necessarily terminating, and you use it to allocate risk. So who carries the risk if the 21 days is extended? Is it the person that employed you? Would they carry the risk that you're allowed to just get out the contract? Or do they want to tie you in and say, we'll give you time, but then we're tying you in at that contract price, even if it's a year. We're tying you down to it. So there are very creative ways to continue with commercial transactions during this time. Insurance. So the question on business interruption insurance. So I was reading I believe it was a PwC international bulletin that came out very recently about insurance. And it's very interesting. So the normal insurance market won't be impacted from the sake of short-term insurance on certain business assets, because obviously this isn't a virus. Obviously, not most viruses would actually impact on assets themselves. What the insurance we're obviously very worried about is business interruption insurance and income protector insurance and like credit insurance. So any insurance that would be used if you have cash flow issues or if you owe money and you're unable to pay the money. And so my understanding of the situation, and again, it's still very unclear because we're trying to see around the world how insurers are dealing with this. I cannot speak to the specific requirements because each insurer would have their own requirements as to what documents need to be submitted in order to consider the claim. But the question now comes down to your insurance policy. Now, after the SARS pandemic that came out a few years ago, what happened is some of these insurers were very specific to include in their policies exclusions for things like epidemics or pandemics. And since they've included that, you'll find sometimes that in situations specific to a virus, that your insurance policy may say, listen, we'll do it in the case of riots, or we'll do it in the case of some industrial meltdown. But if it's a virus, we're not going to touch it because our exposure is too large and we'd have to cover too much of the industry. And unfortunately, they'd be telling you this up front when you've got your policy. And the unfortunate thing is, no one would realize that something like this would happen because they don't even care or read the fine print. But the reality is, if your policy excludes pandemics or epidemics, you might be in a situation where you're not insured, resulting in possibly the need to even litigate if you feel that it was very dishonest, or what the best way to describe it is that the insurer duped you because you had no idea that you weren't covered for this type of event. So as far as I'm aware, it's very easy to submit these claims. Sorry, I just got something stuck in my throat. 1 second. It's very easy to submit these claims. Whether the insurer will consider them is entirely up to the wording of the policy and the next question you need to ask yourself. So for example, if you have a business that's capable of functioning from home, like my firm, for example, it's very difficult for me to claim that that there's any form of business interruption or a large business interruption. There would only be limited interruption. So the insurers would obviously come back with this and would insist that you quantify the level of damages that you're suffering through this interruption, because why can you not work from home? So depending on your industry, so if you're in the construction industry, very well, there you don't have much of a choice. But if you're in an industry like myself or like Shilly Boy, where we're able to function to a certain degree from home, would you be covered by insurance? Simply the outbreak of coronavirus would not necessarily entitle you to receive this insurance payout if you cannot prove that there's been some kind of loss on your end. From a human resources perspective, unfortunately, we don't have too much time. But if you are having human resources issues, and just a very quick note, general rule of thumb at the moment is people cannot attend work. So if people are working from home, if you've given a directive that people can work from home and that there's enough work from home, and you obviously have to pay a salary. If your business, if work cannot be done from home or the work is limited, you are entitled to inform your employees that It is unpaid leave. Now, again, please take this with a word of caution. Every situation is different. So this is just general, the general approach that I've seen in the industry at the moment. If someone cannot work from home, it is unpaid leave, or you can force them to take their normal annual leave. If somebody can work from home, you'd obviously need to pay them. But there is a question now about whether you can effectively demote someone. And what this basically means is approaching someone with an offer and explaining to them that due to the situation, you cannot afford to pay them the full salary. So ideally, you give them a new task or a new function that is almost a demotion. So they would be doing less, but they can do it from home and they would be able to get paid for doing this. So the whole idea of using this demotion is to avoid a situation where employees make no salary, because now you can't afford them to pay them the whole thing, so you'll pay them nothing. And so it's a consideration for them to at least get something out of this, and obviously to avoid something like retrenchment. So very important principles to bear in mind. We don't want to have a lot of retrenchments following the COVID-19 virus. So there are certain negotiations you can have with your employees, and also just advise them as to the relief funds, because there's certain funds that they can apply to in order to receive salaries in case you are unable to pay them. We did touch on financing efficiency already, so I won't touch on this again. If there are any questions, you are more than welcome to send them through to me. Yeah, and just on an end note from my side, using this to your advantage is key to give you that competitive advantage. Understand the law, don't fear it, go for it. Go try do as much as you can in this environment. There's opportunities right now that you can tap into, and there's professionals out there that are more than able to assist you in any of your needs. So don't ever fear any investment, don't procrastinate, just do whatever you need to do and ask the right questions to the right people. And from my side, that's it. I'll bring Shilly Boy on also just to say goodbye. But yeah, thank you for having me. It was an absolute pleasure. Yeah, and hopefully we'll do this again sometime.
Thank you so much, guys. Rapalang, are you still with us?
Yeah, I'm here.
Okay, great stuff. I'll hand over to you, Rapalang, to do your closing.
Yeah, obviously, as I was saying initially to the delegates, that initially if they had indicated that there will be a lot of unavailability from their side, make sure that we don't put them in a corner by having this session today. Otherwise, we would have moved to like convenient time. So, but thank you so much to those that were able to stay on until the end of the session. And we do understand that because of the lockdown, you really have a lot to deal with in time, in the loose ends, and making sure that at some point you finalize, the last part of your project and going to sites and all of that. And I think that's how the session today was kind of like impacted. So yeah, I believe just in the context of what the session was for today, it was really to look at the business structures that you can set in place to make sure that your business is really disaster proof, is pandemic proof, so that when you consider some of these levers that you can use in your businesses, that in future it will help you to make sure that when you face some of these things, you are really protected and you are approved from those kind of situations. So yeah, I think that's really what Shilly Boy and Bruno were trying to achieve today. Make sure that you think the long term into your business and building in such foundation and structures just to make sure that you protect yourself when things like these happen. And I think it was really valuable. And yeah, I believe that the delegates did take a lot of benefits and value out of the session. So that is
Thank
that
you,
from my
Rafael.
side, Jason.
Bruno. Thanks, Chili Boy. Thanks, delegates.
Absolute pleasure. Yeah, you've got my details if you need anything. And yeah, we'll speak again soon.
Bye, guys. Bye,
Bye.
entrepreneurs.
Hi.
Bye.